Hi, my name is Steve Bainbridge. I teach corporate law, including mergers and acquisitions, at the UCLA School of Law. And this is the second in my series of videos on valuation of a business in legal settings. Today, we're going to talk about using the so-called discounted dividend methods. Now, I have to apologize. There's some construction going on in my neighborhood, and you may hear a bit of background white noise, which is some sort of construction machinery running, and I apologize for that. In theory, the value of a share of common stock is the present discounted value of all of the future dividends that are going to be paid by the corporation. Now, this proposition may seem counterintuitive since many corporations pay no dividends. As the theory goes, however, in the long run, all corporations run out of positive net present value investments and therefore must begin paying profits out to the shareholders as dividends or buying back stock, which is the functional equivalent of making dividends. And it's the expectation of those future dividends that determines the present value of the stock. Now, if you accept that proposition, it presents two analytical problems. First, how does one know what dividends are going to be paid in the future? Obviously, one cannot predict future dividends with certainty, and even projecting estimated dividends is a very difficult task to which the full art and science of valuation is devoted. Secondly, how does one discount the stream of future dividends to present value? Well, this is a far simpler task involving applications of the basic principles that arise out of the time value of money, and which we discussed in the first video in this series. Now, the dividend discount models of valuation treat the stream of future dividends to be paid by the company as an indefinite stream that will go on into the far distant future. And in present value methodology, that means that what we're talking about is valuing a perpetuity. A perpetuity is a stream of income that will be paid perpetually, i.e., indefinitely. And the way you calculate the present value of that perpetuity is dividing the value of each installment by the discount rate. Now, we've talked about the discount rate in the last assignment, but to remind you, the discount rate is simply the opportunity cost of capital adjusted for risk. This is a very easy concept to articulate, but a very complex one to actually calculate. Opportunity cost is deceptively simple. It is simply the rate of return on the next best comparable investment. Unfortunately, it can be very hard to identify the next best comparable investment. Likewise, the question of how much to adjust for risk is a highly subjective question. Now, if we turn to applying the methodology for valuing a perpetuity to dividend discounting, we start with what's known as the zero growth in dividends method. This assumes that the dividends the company pays will remain roughly constant in the future. And the value of a share of stock is therefore determined by dividing the current per share dividend by an appropriate discount rate. So value of the firm on a per share basis equals the annual dividend paid on the shares divided by the discount rate. In corporate settings, the discount rate is typically calculated using the corporation's weighted average cost of capital. And the weighted average cost of capital is the sum of the percentage of the company's capital structure that is financed with equity multiplied by the company's equity cost of capital, plus the percentage of the company's capital structure that is financed by debt, multiplied by the company's after-tax cost of debt. We use the after-tax cost of debt because the interest that the company pays on its debts is typically a deductible business expense. We'll talk about calculating the weighted average cost of capital in the upcoming video on the capital asset pricing model. For now, we're just going to make assumptions. We'll simply assume that we know what the discount rate is. So let's apply it. Let's assume that Acme currently pays a dividend of $1 per share. And let's assume that we know the appropriate discount rate is 8%. In that instance, the value of a share of Acme stock is going to be $12.50, a dollar divided by the discount rate. And if you want to know the value of the entire firm, you would simply multiply the value of the share of stock times the number of shares outstanding. Now, the basic dividend discount model has only limited utility when you're dealing with a firm that is still in a growth period. It really applies primarily to mature firms that are basically cash cows. They're not going to get any bigger, but they reliably throw off a steady stream of income. Where a firm is expanding and has continuing growth opportunities, we have to take that potential growth into account, because using historical dividend data will significantly understate the corporation's value. Fortunately, the theories and methodologies of present value provide a solution. In particular, their formula for a growing perpetuity can be used. Some perpetuities pay a constant amount every year in the future, ad infinitum. A growing perpetuity is one where the amounts that you receive increase from year to year. And we know how to calculate the present value of a growing perpetuity, which is the initial amount that's paid on the perpetuity divided by the discount rate minus a growth factor. And we can convert that into a growing dividends version of the dividend discount model, where the value of a share of stock is equal to the current dividend being paid on that share of stock, divided by the discount factor minus a growth factor. The most commonly used growth factor is a multiple of the firm's return on equity times the firm's retention rate. Return on equity is calculated by dividing earnings by shareholder equity. And the retention rate is the percentage of earnings that are retained by the corporation instead of being paid out as dividends. And it's typically calculated by subtracting the dividend payout rate from 1. 1 minus the dividend payout rate gives you the firm's retention rate. Now, if the dividend and the discount rate are held constant, this growth formula will always produce a higher valuation than the zero growth formula, simply because as a mathematical matter, the denominator will be smaller. And again, I think an example is going to be helpful. Suppose Acme currently pays out a dividend of $1 per share. Let's assume that Acme's return on equity is 0.05 and its retention rate is 80%. Assuming an 8% discount rate, we would calculate the value of a share of Acme common stock using our formula with 1 as the numerator. The denominator will be the discount rate, 0.08, minus the growth factor. And remember, the growth factor is return on equity times the retention rate. We use that as the growth factor because, in effect, what it's telling us is how much retained earnings the firm will have on an annual basis to reinvest into the business, to grow the business. So the discount rate of 0.08 minus the retention rate of 0.8%, of 80% rather, times the return on equity of 0.05 gives us, again, a numerator of $1. The denominator is 0.08, the discount rate, minus the growth factor, which is 0.04. That gives us a valuation of $1 divided by 0.04, or $25 per share. And again, if you wanted to calculate the value of Acme as an entire company, you would simply multiply this per share valuation times the number of shares outstanding. And that would give you a pretty good estimate of what this firm is worth. Thank you very much. If you found this video helpful, please like and subscribe to my video channel. Thank you very much.